Happy morning, happy afternoon, and happy evening to all my Nanbas and Nanbis. Items of FS. Attempt on attempt, this comes for 10 marks, and you all will mostly skip this chapter. This is me telling you one day before an exam. Please don't skip this chapter. 10 marks, guys. Just give me 45 minutes. Let's quickly revise all the assets and liabilities and additional disclosure. 5 points, just 5 points are there. That will be a separate video that is not covered here. Just the 45 minutes of assets and liabilities. Please do it with me. I assure you of the 10 marks. Let's go through all the concepts really quickly. Let's dive into the video, guys. Now, warm notes of PPE. PPE mind mapping, how did we start off? That was the biggest mind map, correct? Recognition criteria, elements of cost, cost which is added, cost which is excluded, then comes audit procedures and then disclosures. Under audit procedures, how many points are there? 4 assertions are there. What are the 4? Existence, completeness, valuation and rights also is there. Obligation and all will not come for asset. Obligation is only for liability. So rights only is for asset. Now, under PPE, the recognition criteria is when there is future economic benefits. Cost can be measured reliably and it can be measured at cost. You can read it, correct? Elements of cost. PPE include purchase price and includes import duty and non-refundable purchase tax after deducting trade discount and debate. You will not be reducing what? Cash discount here. Directly attributable to bring to location and the condition. Initial estimate of dismantling, removing, all of these things will be directly attributable cost. Directly attributable cost, specifically they have told employee benefit AS 15 will be a directly attributable cost, but something related to employees, they said that it is not directly attributable cost. Staff training cost is not directly attributable. So employee benefit as per AS 15. Site preparation, initial delivery and handling, installation and assembly, cost of testing, doing the samples and professional fees also will be directly attributable cost. Cost which is not PP, only 4 points. Inauguration cost, introduction of a new product or service, a new business or customer, and admin or other general overheads. The next is the audit procedures. You told me there are 4 assertions. The first one being existence. Existence na sonnale physical verification. It can be done by own staff or third party, and periodicity will be decided by the company. So as an auditor, we will have to ask them whether they are doing once in a year or once in 2 or 3 years. If proper supervision is done, and physical verification report must be given. In that report only all the items of PPE must be properly tagged and it has to be properly reconciled with the fixed asset register. And if there is any discrepancy, that has to be accounted for properly. Completeness means what? The movement in the fixed asset schedule, that is opening plus addition minus deletion, that gives you the closing. Now this talks about the arithmetical accuracy, where you will be tallying the opening balance to the previous year, and under completeness only there is addition and deletion. The same addition and deletion we also saw for intangible asset. Same completeness addition deletion we saw. Under addition, here expenses meet the criteria for AS 10. In intangible asset, expenses meet the criteria for AS 26. Like that we did a comparison. You remember? Now spare parts, standby, servicing equipment as per AS 10. Otherwise it will be inventory. You will test purchase the invoices and get the installation certificate. See whether any addition to PP is approved by the authorized personnel. If there is internal process for quotation, floating tenders, etc. The same points will be there for deletion also, because when you delete also you need to get the quotation, floating tenders, understand the reason and rationale for deletion. Here also you require management approval. Accurately recorded and accumulated depreciation up to the date of disposal must be there. Process followed, competitive quotes and tenders. The next assertion is the valuation assertion. Valuation means you talk about depreciation. The depreciation is done for all items, and if it is a non-depreciable item, for example freehold land, you will not be
calculating the depreciation. So depreciation reflects the pattern of future economic benefits, and if there is any impairment, it has to be done under AS 28. Then comes rights. Rights means they are the legal owner, legal title that they only have. So whenever there is a purchase invoice of PPE, what is the name in that invoice? Addition to land and building, you will be checking the sale deed, conveyance sale deed. Original title deeds you will be checking, and security, if it is used for borrowing, then you will get a confirmation from the lender, and register of charges. Next is disclosures, classification, land, building, plant, furniture, fixtures, vehicle, office equipment and others. Lease assets specify separately under each class. Reconciliation, if change is more than 10% in each class, you have to show it separately. Any sum written off, reduction of capital, revaluation of asset for a period of 5 years, 5 succeeding years, you will have to show. This third and fourth point will again flow through in intangible assets also. Next comes intangible asset. Here the mind mapping flowed as what is intangible asset, what are the audit procedures, and what are the disclosures. Now what is intangible asset? It is an identifiable non-monetary asset without physical substance, held for use in production, supply, rental or administration. It is internally generated goodwill is not an asset. Can I say goodwill itself is not an asset? No. Purchased goodwill will be an intangible asset, but any goodwill which is internally generated, for example, I told you Domino's, wherever they open the outlet, you will definitely know that pizzas will get sold. There you know that there is a goodwill which is created, but that is an internally generated goodwill. You will not know what is the value of that goodwill, so you will not be recognizing that as intangible asset. But a goodwill which is arising because of purchase, where the valuation is 4 crores, but you paid 5 crores to purchase a business. So here the 1 crore which you are paying extra is called as purchased goodwill. That will be an intangible asset as per AS 26. Next is audit procedure. Under this again there are 4 assertions: existence, valuation, completeness and rights is also there. Existence, whether it is in active use. If it is not in active use, that means the intangible asset has been deleted. If it has been deleted, whether it has been recorded in the books of accounts, and if it has been deleted, it should also be after the approval of the top management. What is completeness? The same thing of PPE, verify the movement, opening plus addition minus deletion will give you the closing, and arithmetical accuracy. For addition, recognition criteria, there it was as per AS 10, here it is as per AS 26. There we spoke about spare parts and all. Here research phase of internal project should be an expense and it should not be an intangible asset. Certificate or report to verify the date of use of intangible asset. If there is any addition, then approval by the appropriate personnel must be there. Internal process must be there for competitive quotes and tenders. Deletion, simply you cannot delete, there must be a reason and a rationale for deletion. Approval and disposal note must be there. The process of sale must be given properly and accurately recorded for deletion, and it should be recorded in the general ledger also. For valuation, there we saw depreciation for PP. Here you're going to see amortization. Charge the amortization over the useful life. This is going to reflect the pattern of future economic benefits again. There also we saw this future economic benefits. There also we saw AS 28 impairment. Here also same thing. Rights, expense invoice or purchase contract. It should have the name of the entity. There also we saw whenever there is a purchase of PPE, the name must be there in the invoice. The disclosure, the classification must be given as goodwill, software, mastheads, or publishing title, mining rights, copyright, trademark, intellectual property rights, recipe, formula, design, model, prototype, license, franchisee, everything. The same third and fourth point, reconciliation. Revaluation more than 10%, if it is there for each class, you will have to mention that separately. And sum written for reduction of capital or revaluation of assets for the succeeding 5 years period, you will have to show that. The next is trade receivables, which is the opposite of trade payables. From there it is flowing, and from trade receivables you can actually map it to loans and advances, multiple points. So trade receivables, what are the mind mapping that we did? The first one a little different, it was the test of controls for internal controls over sales, because trade receivable means we have to receive the money for whatever we have sold previously. So from there it is flowing. Then we went to audit procedures. Under audit procedures, how many are there? 3. What are the 3? Existence, completeness, valuation, and there is also direct confirmation procedure. Whenever there is a trade receivable, trade payable, there is a direct confirmation procedure. Now, coming to test of controls for internal control over sales for debtors, only bona fide sales leads to trade receivables. There must be segregation of duties. If there is any credit sales, it has to be collected on time. If it is not collected on time, whether reminders have been sent and whether legal action has been taken for the credit sale which has done. The balances, whether it has been regularly reviewed by the management, whether the sale has been done only to approved customers and the sale has been recorded in the books of accounts. You can either settle it by receipt of cash or by an approving authority, we saw. And aging schedule, always trade receivable, trade payable, aging should be a point. Next is completeness. Completeness killer, they're talking about cutoff procedures where the sales must not be understated or overstated. Under that last few days of invoices, that is 5 or 10 invoices on the last few days, you will be picking and you will be seeing whether it is pertaining to this period only. Apart from this, goods dispatched prior to the period end has to be invoiced in that period itself, and goods dispatched after the period end must not be invoiced. Aging report, you will be testing the invoices, match the invoices to shipping or dispatch log, and few sales point we saw. What is bill and hold sales? I will bill now but I will not sell the product, I will sell after 2-3 days. Subscription model example and all I told you. Receiving log, I will bill now, I will sell now, and the next year I will take it as a return. So I will see the receiving log for the company. What is the returns which has happened? What are the discounts, incentives given, and what is the credit memo? This is under completeness. The next is valuation. Again, aging report, debtors under litigation. If there is any provisions for the doubtful debts, whether there are any doubtful debtors, what is the schedule of the movement, and whether it is approved by the appropriate authority. The next is existence. Controls are in place that invoices are not recorded more than once, because I will just sell once and I will record 10 invoices. I will inflate my sale, inflate my profits. As an auditor, we need to check that all those things are not happening. Balances are automatically recorded. Period end accounts receivable, aging report, again trace the balances with the general ledger. Realization must be recorded chronologically, invoice wise, FIFO, we saw that point here. Invoice wise it has to be done. Large balances which is due for a long time, you have to ask for reasons as to why it is due for a long time and what is the justification. Direct confirmation procedure, you can contact the customer directly and you will be asking all the confirmations from them. How can you ask the confirmation? Either you will be giving the outstanding amount or you will ask them to give the outstanding amount. Form with balance, without balance. Date, it can be at balance sheet date or any other date which is close to the balance sheet date. Consent must be received by the client, but the method of selecting the trade receivables must not be revealed to the client. Method of selection do not reveal to the company. Discrepancies, if there is any, then it will have a bearing on all the other accounts. And if the external confirmation is not working, that is no reply has been received, then we will be doing a alternate audit procedure. Later, if cash is received subsequently, no problem. Otherwise, we will be doing a detailed analysis. If there is a related party receivable, see whether it is at arm's length principle. See the trend line analytical procedures. Receivables other than sales or services must not be there in the list, because trade receivables means you are selling something and because of that credit period they are falling due. So other than sales or services must not be there, and few disclosures. This is trade receivables, exactly the opposite of trade payables. Where and all did we see opposite of trade payables here? Under this direct confirmation procedure, under disclosures, they are also secured, considered good, unsecured, considered good, doubtful, debts due by directors, firms or company in which the director is there. Same points we saw. Valuation also similar. No, valuation from here will flow here. Under litigation, compare loans, same thing will be flowing here. So from trade payables, only direct confirmation procedure. Completeness. Existence also. Yes, existence also. Existence and direct confirmation procedures. Now loans and advances. loans and advances here also includes, this is loans and advances in the asset side of the balance sheet. The company has given the loan and it has to receive the loan back. It includes loans and advances which is given to related party, and any advance which is given as a security deposit, and any amount which is given in cash or kind. So other current assets includes balances with statutory or government authorities also. What are the audit procedures? Here only three: existence, valuation and completeness. Existence, direct confirmation procedure similar to trade receivables. Here we saw, correct, trade receivables, but here direct confirmation procedure, same thing will flow, but along with the principal plus interest also will be there. Also include interest receivable, also included as part of balance verification. The next assertion is the completeness assertion for loans and advances. That is, the company is giving a loan and it is in the asset side. How do I know that it is complete figure? For that, list of all the advances and other current assets, ledger balance, I will get the loan agreement and acknowledgement as per MOA, AOA and advanced by directors and partners of the firm and trustees of the trust. Minutes of the meeting of board of directors, any security deposited against due repayment, any related party loan and advances, whether it is an arm's length, authorized and whether it is reasonable, and GST input tax credit. This also the reasonability we will have to see. I also told you about the question they asked specifically with GST input tax credit. That time you will have to write what are the returns which is filed, if there is any refund, how is the books of accounts showing, and if there is any amount which is received at a subsequent date, how are you showing it in the bank statement. The next is what? Valuation. Again, aging report, loans and advance under litigation, compare it with the previous year. If loans and advance appear doubtful, how will you treat that? Bad loans and advances written off. How can you written off? Somebody has to approve and authorize the loans and advances to be written off, and if the loans have been received in foreign currency, then you will be showing as per AS 11. Next is disclosure, long term, short term, and common disclosure for short term and long term. Under long term classified as capital advances, related party, others. Short term again classified as related party and others. For related party transaction, you will have to show the type of borrower, amount and percentage to the total. Common disclosure for both loans and advances due by director, firms or company in which director or director partner member, secured considered good, unsecured considered good and doubtful. Here undisputed trade receivable which is good, doubtful, undisputed trade receivable which is good, doubtful, outstanding from due date of the payment. Now the aging will start from less than 6 months, 6 months to 1 year, 1 to 2 years, 2 to 3 years and more than 3 years. Is that clear, guys? Is it ringing a bell? Are you able to map the points once we are going through the WAV notes? The next is inventory and cash equivalent. Under inventory, what was the mind mapping that we did? What is inventory? Audit procedures and disclosures. What is inventory is given here. We saw inventory and 3 points were there: raw material, work in progress, finished goods. Held for sale in ordinary course of business, that is the finished goods. Inventories are assets in process of production, that is the work in progress. Inventories are assets, materials or supplies consumed in the production process, that is raw materials. So raw material, work in progress and finished goods, these are the assets, and what is inventory is these 3 points only. Coming to the audit procedures, how many are there here? 4 are there: existence, valuation, completeness and rights is also there. Coming to the existence. Now actually there are only 6 points in existence, and the last point with regard to test count, and under that so many general points were there if you remember. So quickly let's go through the first 6 points of existence. Now existence na sonna inventory, physical verification of inventory you will have to check. Who will be doing the physical verification? The management, the company. Review the entity's plan for inventory count. If there is any consigned goods, whether it has been segregated properly, it should not be mixed with the total inventory. An auditor should participate in the inventory count. Periodic system, if it is at the end of the period, and if it is perpetual system, you can do the inventory count at interim dates also. If the inventory is held with a third party, then you will be investigating with the third party directly. Then you will be doing the test count. All the 6 points are with respect to physical verification of inventory, because we are talking about existence of the inventory. Now under the test count only, there are multiple general points. 10 points are there. First one is observe that the employee is doing the proper inventory count. I told you the example of GRT where they'll have to do the inventory count every single night. So whether they are actually doing that, and one person has to supervise it. Whether there is tags for the inventory, and the tag need not specifically be only financial information, even non-financial information like weight can be there on the tag. All items must be tag, and tag must be proper amount. Tag of summary sheet, tax is given, it is tag. Tag of proper amount, tag and summary sheets, whether it is controlled and reconciled, discrepancy in the reconciliation, whether it is summarized and agreed with the client, staying alert for any empty box or obsolete item, cut-off procedure, for that you will be seeing the last 5 to 10 shipping documents, exclude any damaged stock, obsolete stock or any third party stock which is lying with the company, you will be excluding, accounting of all the stock sheet and difference between physical stock and stock records. All of these general points is under test count. The first 6 was for physical verification of inventory, which was for the assertion existence. Now comes completeness of inventory. Completeness means inventory held by the entity is there. Inventory held by third party lying with the company is not there. Inventory owned by the entity lying with third party is there. Is that clear? This 3 is what is talking about what is completeness. Now under that analytical procedures, under that few ratios are there. Inventory turnover ratio, COGS by average inventory, vertical analysis can be given, inventory by total assets, and budgetary versus actual inventory. Non-financial information, weight also can be given. Now inventory is flowing from where you purchase the material, it is as inventory, and from the inventory you are going to give the sale. So the purchase and sales cut-off procedures has to be done for seeing whether the inventory valuation is complete. Tagged inventory you will be testing for omitted transactions or invalid transactions. Reconcile for perpetual records, general ledger which is there with the third party, and anything which is given on consignment basis must not be included along with the inventory, it must be segregated properly. This is the completeness. What is valuation? Valuation of inventory is cost or net realizable value, whichever is lower, and whether they are using FIFO or LIFO or weighted average, consistently they will have to use that. Now under valuation only we also saw raw materials, work in progress separately and finished goods separately. Reasonableness of the method use, FIFO, LIFO or weighted average. For raw materials, what are the elements of cost which you will be considering? Standard versus actual cost. If there is any variance analysis that you have to do, what is the test check? If there is any damaged or obsolete inventory, you will obviously take it at net realizable value, because it is damaged and obsolete, it will be lower than cost. So that's the reason why you are taking as net realizable value. What is work in progress? You will be measuring the cost appropriately. What are the elements of cost? And here also you will exclude all the abnormal wastage. Finished goods, here you will be valuing at NRV if lesser than cost. That means cost or NRV, whichever is lower. And valuation of obsolete, damaged, slow moving inventory must not be there, and inventory aging split must be given. Apart from this, compare recorded cost with replacement cost, vendor price list, inventory turnover ratio in manufacturing environment, test the overhead allocation rate. This is under valuation of the inventory. The next assertion is the rights of the inventory. Rights means the valid legal ownership is held by the entity only. Here what will you see? The invoice must have the name that it is owned by the company, that is vouch the purchase with documentation. You can see the PO, you can see the invoice, you can see cancel check, payment file, receiving report and all of those things. Invoices must have the name of the client. Material purchased must be having the commitment agreement, consignment agreement. If there is any collateral agreement or there is any side agreements, you will be seeing client correspondence with sales and receivable records, purchase record and declaration from the third party in the letterhead. Last part, disclosure. Raw material, work in progress, finished goods, and if there is any stock in trade, you will have to mention that separately. Stores and spares, loose tools, others. Whether goods in transit, that also must be separately disclosed under each of the subheading. Is that clear? This is with inventory. Easy, half a page. full inventory in half a page. Next one is cash and cash equivalent, 1/4 of a page, small one down. Pavama, it is sitting here. Cash and cash equivalent. What are the mind mapping we saw here? Audit procedures and disclosure. Under audit procedures, existence and completeness, you will be doing the surprise check. If there is more than one cash balance, that is maybe there is a cashier, petty cashier, and also employees having different cash balances, simultaneously you will be checking the cash check simultaneously, and when you are checking, the cashier must be present, otherwise he is going to be like, when I gave it to you, cash was there, now cash is missing, he is going to put the blame on you. If there is any rough cash book, then whether entries are flowing from the rough cash book, you will see. If it is approved by authorized official, you will also do cash sensitivity analysis and bank reconciliation statement. How are you going to do the BRS is given here. You will be tallying the bank book with the bank statement. If the checks issued but not presented for payment, then the bank statement will subsequent period verify if it is cleared. Check becomes stale or more than 3 months have been lapsed, then it should be as a liability. Material reconciling items, then you will be requesting for bank statement. If management doesn't adjust, then you can even go for qualification of the report. Checks deposited but not credited by the bank, then in your accounts it will reduce the bank balance, but in your account it will increase the bank balance, but in actual bank statement it will not be reflected. So the check deposited later when it is credited by the bank, so you will be asking for bank deposit slip. Checks not cleared beyond reasonable time, why is it not cleared? You will be asking for explanation. If that explanation is unsatisfactory, then you will verify the revenue recognition. Direct confirmation procedure, to whom will you ask directly? To the banker only you will be asking directly. Confirmation of 100% of the bank account balances you can ask. This material is done olden days, so they are saying, how will you get the direct confirmation procedure? Your team member along with management team member, both of you will go physically to the banker and ask them for the statement, not statement, for the balance. Next is disclosure, classification, cash in hand, cash in bank, check, draft in hand, otherwise. Earmarked balances you will show. This is also called as fund. Margin money or security, if it is shown separately, you will be showing that. Repatriation restrictions if it's there, and any deposits which is more than 12 months, you will have to show that separately. With this, the balance sheet items comes to an end. You all told we'll finish now, that's the reason. Now under share capital, what is the mind mapping that we did? Audit procedures, issued at a premium, issued at a discount, sweat equity shares and reduction. Now under audit procedures, what are the points that we saw? Tally period end share capital balance. Share capital balance with respect to authorized, issued and paid up. If there is no change, then you have to get a written confirmation from the company secretary. If there is a change, then whether it is within the limits of authorized capital. This authorized capital will be given where? If there is, the resolution has to be passed for increasing or reducing the authorized capital. If there is any fresh issue of shares, then the Companies Act has to be complied with. If there is, the shares should not be issued at a discount, the auditor has to check for that. If the shares have been issued for cash or for consideration other than cash, the auditor has to check. Then we have to see SEBI complaints, MCA complaints, Form SH7, Form PAS3 and Form FCGPR for any foreign direct investments. In this form, you will have to verify the number of shares and price. If there is any increase in share capital, how is the fee calculated? Stamp duty which has been paid to MC. Very easy once you see this, yes or no. Then next we have to go to issued at a premium. You are able to recollect all the points, correct? Issued at a premium. Company shall transfer the premium amount to securities premium account. Then he will have to state the purpose. Restrictions for application of securities premium account. Only for these 5 there are no restrictions. What are these 5? That means securities premium account can be used only for these 5 points. First is issue of unissued shares for fully paid bonus shares, buyback of securities, right of preliminary expense, premium payable on redemption of redeemable preference shares, right of expenses or commission paid or discount allowed on shares. Now for shares issued at a premium, auditor needs to verify only 2 points. One is whether premium has been received and whether the transfer has been done to the securities premium account, and it has been used for only these 5 purposes. Is that clear? Next, going to shares issued at discount. Can you issue shares at discount? No, you should not issue shares at discount, and this has been given under section 53. And shares issued at premium given under section issued at premium given under section? No. No. Sweat equity shares is 54. Discount is 53. Issued at premium is 52. Now, issued at discount. Section 53 of the Companies Act says that you cannot issue shares at a discount, and there are a few exceptions. And if you issue shares at a discount, then it is void. Only one exception is there. That is that first itself they say you cannot issue except for sweat equity shares, but specifically exception is given, that is for a creditor if you are issuing a share under a debt restructuring scheme as per RBI guidelines, then that is an exception. Now, if you do not follow the provisions of this act, then there is a penalty. What is the penalty? Company and every officer in default is liable to a penalty for the amount raised by way of discount on shares, or rupees 5 lakhs, whichever is lower, and he is liable to refund all the money that he has received along with an interest of 12% per annum. For this, auditor needs to check only 3 things: movement in share capital, he needs to read the minutes of the meeting, and if the shares have been issued to the creditors as per RBI guidelines, whether it is as per RBI guidelines, he'll have to check. Sweat equity shares under section 54 of the Companies Act, where you will be issuing shares at a discount or for consideration other than cash. Here, auditor needs to verify special resolution, and in this special resolution, it has to specify the number of shares, current market price, consideration, class of director, class of employee. If listed, then the SEBI guidelines has to be seen. Rights, limitations, restrictions, provisions, all of this for the sweat equity shareholders are the same as the equity shareholders also. The last one is the reduction of share capital, where there is accumulated business loss, assets of reduced or doubtful value, or paid up capital in excess of requirement, or surplus capital can't be employed. Now, for the financial health of the company, they will be reducing the capital of the company. Now, if they reduce, definitely they must have a special resolution, and the words "and reduced" must be added to the name. Special resolution, and this has to be authorized in the AOA and MOA. They should not be defaulted for repayment of deposit. If there is any order of tribunal confirming this reduction, you please read the order of the tribunal. See the registrar certificate. Accounting entries, reduction. It is actually complicated accounting entry, yes or no? So see whether they have done the accounting entries properly. If there is any revaluation of assets, see that the words "and reduced," whether it has been done by the tribunal, and when they are doing it, if there is any terms and conditions which is issued by the tribunal, check that also. This section does not apply for buyback of own securities under section 68. The next is disclosures. You can go through that: A, B, C, D, E, F, G, H, I, J, K, L, M. 13 points for the disclosures. Next, where did we go to? Reserves and surplus. That's it. Half a page. Not even half a page. This much only is there of reserves and surplus. Now, for reserves and surplus, what is the mind mapping we did? We first saw what is a reserve, then we went to audit procedures, then we went to disclosures. That's all we saw. Now, what is a reserve? Amount appropriated out of profits, not intended for a liability, not intended for a contingency or a commitment or diminution in value of asset. Now, this is segregated into 2. You can either have a revenue reserve or a capital reserve. Revenue reserve means it is available for distribution to the shareholders. Capital reserve means it is not available for distribution. Now, this revenue reserve has a few purposes. Supplement divisible profit during the lean years. During the lean years means what? At times when the company is not making so much of profit, then from the previous revenue reserve I can distribute as dividend. Finance an extension of the business, augment for the working capital and to strengthen the financial position. That means even for marketing expenses also I can use the revenue reserve. Capital reserve means I already told you, that means it is not free for distribution, it is only for a limited purpose. Examples we saw: capital redemption reserve, securities premium, revaluation reserve, debenture redemption reserve. All of these things are examples for capital reserve where they cannot be used freely and for specific purpose only. Under audit procedures, there were only how many assertions we saw? 3 assertions. The first, existence, single point was there where opening balances from the previous year audited financial statements you will be tracing from there. So opening balances and current year reserves and surplus from the previous year audited financial statements you will be getting that. Completeness and valuation assertion, for any addition or utilization you will be seeing the tracing the movements of the P&L balance, tracing the movements of the statement of changes in equity, and the resolution of the board of directors for the recommendation of the dividend. Now if this dividend has been recommended prior to 31st March, then accounting standard is saying you do not need to recognize as a liability, but if it is declared after the date of balance sheet, but the financial statements have not been approved by the users of the financial statements, you still have to show it as a subsequent event. Then we come to disclosure, classification, CRR, CR, securities premium, DRR, revaluation reserve, shares option, outstanding account, others, and surplus. Then we saw what is earmarked investments. That means we will call that as fund. Note, balance of reserves and surplus after adjusting negative balance if it comes, loss if it comes also, obviously you will be transferring that loss to the balance sheet under reserves and surplus only. The next is borrowings. What is the mind mapping that we did for borrowings? Audit procedures, auditor to read, and then disclosures. Audit procedures very easy, same 3 assertions: existence, valuation, and completeness. Auditor to read, we saw 13 points were there, and then we went to disclosures. Now audit procedures, existence, valid claims by bank or third party. I told you directly they will not give you an assertion saying you please write the audit procedures to confirm the existence of borrowings. They are not going to ask questions like that. How are they going to ask? What are the audit procedures for the valid claims by banks or third party? That means you should understand that they are talking about existence of borrowings. Now here, what are the points under existence? For any kind of borrowings, first they will be having a meeting between themselves. Under that meeting, what will they write? Minutes of the meeting. So first, minutes of the meetings, whether they have authorized for the borrowings, whether it is as per loan agreement. You all told me borrowings means the first point you will write is loan agreement you will be writing. Next is independent confirmation from the direct confirmation you will be getting, that is SA 505 external confirmation. Lease and hire purchase creditor, if there is a debenture trust deed you will be reading the deed also, similar to that loan agreement. If the debt is retired, then see the discharge whether it has happened on the asset also. What is the meaning of discharge? I told you, if a debt is created, you will be creating a charge on the asset. If a debt is retired, if it will be repaid, that means you will be discharging the asset. Next is written representation you will have to get from the management. The next is completeness. Are they going to say completeness assertion? No, they are going to use the word whether it has been recorded in the books of accounts on a timely basis. That means they are talking about the assertion completeness. Now under this completeness, schedule for short-term and long-term borrowings, you will have to see the minutes of the board of directors, the contracts, confirmation, and cash disbursements. Trace the closing balance as per the schedule to the general ledger, and subsequent transactions after period end or fresh loan near the balance sheet date, you will be getting the direct confirmation procedure. Direct confirmation procedure, you will be asking for all the information, you will be sending the reminders, and once you get the confirmation, you will be comparing it with the balances in the books of accounts, that is compare the balances. Next is valuation. How many points are there under valuation? Only 5 points are under valuation. First is accounting policies and accounting methods, whether it is appropriate and whether it is consistent. Loan agreement, everywhere you will be writing this point. So whether it is as per the loan agreement. Recomputation of the interest, recomputation of the premium, recomputation of the discount has to be done. Computation of amortization of premium or discount, and if it is any foreign currency loan, AS 11, reinstatement of foreign exchange also has to be done. Auditor to read, 13 points are there. Under borrowings, 13 points are there. Auditor to read provisions in the agreement. You will be doing a test compliance for all the covenants which is there. Covenants means any rules which has been framed. Rules can be like no fresh loans, no fresh borrowings should be there, or a debt equity ratio of 2:1 has to be maintained by the company. So that is test compliance. If they have not complied with, you have to show as current, because if they have not complied with the rules, that means you are liable to pay that money immediately. So you have to show that as current. Now, if you have not complied and if the third party is okay with your non-compliance, then you have to get a confirmation for the waiver directly from the third party. Those 3 points only are given here. Read provisions in the agreement, test compliance. Non-compliance means you will classify as current. If it is waived means you will get a confirmation from the lender. What are the due dates you will be seeing in the agreement? Proper classification for long term or short term. For a long term borrowing, if the installment which becomes due is less than 12 months, say 1 crore of borrowing, but within 12 months you have to pay 1 lakh. 10 lakhs. Then that 10 lakhs has to be shown in the current year. So whether they have shown that correctness, you will have to see. Restrictive covenant, whether there is any restrictions placed in the agreement, you will have to see. Important terms, if there is any statutory requirements for creation of charges, then you will be seeing the registration of charges. If the value of security becomes lesser than the loan outstanding amount, that means there is no guarantee that the company will repay the money, so you will call until the market price of the value of the security as secured borrowings. Apart from that, you will be calling that the unsecured borrowings. To the extent of market value of security only, it is secured loans. Next, you will be reading the hire purchase agreement. If there is any related party loans, AS 18, arm's length, those words and all you will be using. If there is any bills discounted, negotiated, whether it has renegotiated, all those things, it has to be disclosed in the financial statements. The borrowing powers has to be as per Articles of Association and Memorandum of Association. Section 180, 185, loans by directors, promoters, all of those things also you will have to see. And any purpose of that loan has to be used for that purpose only. Especially a short-term loan should not be used for long-term purposes as per CARO clause number 9. Accepted deposits should be as per the guidelines of the RBI. This is auditor to read. The last one is the disclosures. Under disclosures, we saw subclassification, secured, unsecured, long-term borrowings, bonds or debentures, term loans by banks, term loans by others, deferred payment liability, deposits, loans and advances from related party, long-term maturities, finance or lease obligations, loans guaranteed by directors or others. If it is guaranteed by directors or others, aggregate amount of such loan, bonds or debentures in the descending order of maturity. Redeemed bonds, power to reissue, terms of repayment, period and amount of default, other long-term borrowing, trade payable, others, short-term borrowing, loan repayable on demand, banks, others, loans and advances from related party transactions, deposit, others, notes. If company has borrowing, security of disclose quarterly return, security of current assets, then you will be disclosing these 2 points, CARO points again. Quarterly returns or statement of current assets should be as per the books of accounts. If not, then summary of reconciliation and the reasons should be disclosed. This is borrowings. The next item is other one only. Provisions and contingent liability. Trade payable, no need to do, because trade receivable we will do, and ulta of that is only trade payable. So last one, provisions and contingent liability. What is provision, what is contingent liability we saw. Next we went to audit procedures, and last one was disclosures. Disclosures same as schedule 3. Now only what is provision, what is contingent liability, audit procedures. That's it. Then we'll go for short commercial break. Is that okay? What is provision? It is a liability measured by degree of estimation. It is recognized when present obligation as a result of past event, probable that outflow of resources will be required to settle the obligation, and a reliable estimate. Example for provision, you all told me provision for bad and doubtful debts, provision for taxes, and all of those things. Contingent liability and provision for warranty, that also will become. Warranty means I am making a sale for legal or constructive basis. Yes, constructive means provision for bad and doubtful debts. Warranty means you have to compulsorily have that provision, because if you make a sale for 10 lakhs, month on month you are recognizing that 1 lakh is coming as a return for warranty. So you have to undergo that repair expense. So you will be creating a provision for warranty there. Contingent liability means material uncertainty. There is a 50-50 probability. Example we saw was lawsuit. So it is a possible obligation arising from past event and whose existence will be confirmed by occurrence or non-occurrence of one or more events not within the control of the entity, or present obligation arising from past event but not recognized that it is not probable that outflow of resources will be required to settle the obligation, or amount of obligation cannot be measured with reliability, because at this date I do not know whether I will win or lose the case. Even if I lose the case, what is the amount of outflow which will go, I do not know. So that is a contingent liability for me. What are the audit procedures here? Are they talking anything about assertions? No. Direct general audit procedures. List of all provisions, compare with ledgers, inspect agreement with the customers, underlying working from management, and obtain expert underlying work. How will you use the management expert? Evaluate the competence, capability, and objectivity. When was this asked? September 24. Idella mattu you will know. Evaluate competence, capability, and objectivity. How will you see this? Whether he is an independent party or he has been employed by the entity itself. What is the previous experience with the expert? What is his knowledge, qualification, and what membership, and where professional body he has the membership, you will be seeing. Next is obtain understanding of work of expert. How are you going to obtain an understanding? Whether the auditor has the expert to evaluate assumptions and methods used by management, nature of internal or external data of expert. Evaluate the appropriateness. Here you will be seeing the relevance and reasonableness of the source data, and you will be getting a written representation from management for all the provisions which is created. With this, the liability side of items of FS is completed.